Self-managed superannuation funds have been able to use gearing to acquire assets for almost 2 years now. With me in the studio today, I have Grant Abbott from SMSF Strategies to go through some of the facts surrounding borrowing in an SMSF. Welcome, Grant.
Darren, great pleasure to be here again.
What are some of the rules surrounding SMSF borrowing?
SMSF borrowing is to me probably the most exciting area of self-managed superannuation funds at the moment. And as we've discussed on many times before, there's a few dark clouds on the horizon in terms of investments and stuff like that. But SMSF borrowing really takes strategy to a new level. It's now virtually 2 years or 2 years that we've had these rules in place. It's been a really slow, drawn-out affair to get them, but in essence, if I break it down to a nutshell, the laws basically state that a trustee of a self-managed superannuation fund can borrow monies. Those monies can be borrowed from two ways. One is from, say, a bank or commercial operation, or privately, for example, a family trust or an individual themselves. So they can borrow monies to then acquire an asset. That asset could be residential property, commercial property, managed funds. It could be virtually anything that the trustee of the fund is allowed to acquire. Of course, there's a whole lot of rules which are embodied in Section 66, which says the trustee of the fund can't acquire an asset directly from a member or related party unless it's business, real property, unless it's managed funds, unless it's listed shares. Anything outside that, for example, residential property owned by a member, can't be acquired. So the trustee of the fund can acquire these through a borrowing. Now, the only other couple of elements there is that that borrowing has to be done by way of a trust. It's like an instalment, effectively buying by instalment. The trustee of the fund puts up capital, let's say 20%, borrows 80% from a bank. What happens is the legal title of that asset doesn't go over to the trustee of the fund, because otherwise that would be the trustee of the fund borrowing directly. So what happens is it goes over to what we call a custodian trust. Someone's actually sitting there and saying, look, there's a deal on, trustee of the fund's borrowing money. What happens is I'm standing, I hold the legal title to this particular property, and I'm going to hold it until the last of the money's come through from the self-managed super fund, and then the legal title passes from me, the custodian, down into the self-managed superannuation fund. Now, it's important that they do it that way, is that the custodian owns the legal title. The lender is owed that money over the period of time that's really struck between the self-managed super fund and the borrower and the lender. And more importantly, there's all beneficial entitlement to the interest is owned by the self-managed super fund. For example, all dividends, if it's margin, if it's shares or rents, will all flow down into the self-managed superannuation fund. But it's also important, this is the final one, is that the custodian trust stands in there in the event that there's a default by a self-managed super fund, which to me is extremely unlikely. If there's a default by the self-managed superannuation fund, then what happens is the self-managed super fund can just walk away. It's non-recourse, and then all the lender has access to is the underlying property. So it's what I call a non-recourse loan. So the keys are, one, borrowing of monies; secondly, acquisition of assets; third, you must have a custodian trust; and fourthly, it's a non-recourse loan. Pretty simple, actually, when you put it in place.
And in general, what sort of assets are people using borrowing to acquire?
Well, I've found there's probably at the moment, over the last 2 years anyway, it seems to be that trustees are moving away from shares. Whether it's right or wrong, I've got no idea. I'm not a great big investment person myself. But they're certainly going back to probably bricks and mortar. Bearing in mind that a lot of the trustees of the fund certainly have invested in bricks and mortar through their own home over many, many years. And I would also say a lot of the entrance over the last 10 years into self-managed super fund, probably in the last 20 years have probably had an investment property which they've negatively geared into. So they're used to borrowing to acquire property. So we're seeing a lot of movement now for self-managed superannuation funds using their funds to acquire commercial property, which they're getting on people who've got good tenants, good yields, and some amazing yields there. And also even going down the track of getting residential property, which again we're starting to see some good yields there, and also lifestyle or resort-related property throughout Australia. So they seem to be the three hotspots at the moment.
And who are the major product providers for instalment warrants right now?
Well, to start off with, Westpac was out there like a shot with its sort of product. There was a couple of concerns with its product, and I think that anyone looking down this track, probably if you went on to our website www.smsfstrategies.com, had a look, there's a whole lot of stuff on borrowing there, but the Commissioner's come out with a whole lot of guidelines around these particular borrowings. One of them was that the lender can't get a personal guarantee, otherwise it's sort of moving against the non-recourse nature of that particular loan. So Westpac were out. They seem to have moved back, and the 3 or 4 big players in the market, certainly the biggest one by far is NAB. Got a very competitive product in the marketplace. I think some of the interest rates are only like 5.7 or 6%. You've got commercial, you've also got residential. LVR is up to around about 70%. You've also got St George, so I think Westpac's pulled out and St George has taken its place, and they've got an extremely competitive product. CBA and also Westpac. So now all the major banks have got some really good products. It's worthwhile making sure that you have a chat with I suppose your advisor, your accountant about the products, or even some mortgage brokers. Now believe it or not, there's some mortgage brokers who specialise just solely in these SMSF borrowings. They're the ones you want to get on top of because they'll make sure they get the best deal for you.
So what sort of documentation do you need?
I think this has probably been the big burden over the last maybe year or two, and it's why it's taken a long time to really get going, is that the documentation to start off with. Lawyers were charging about $10,000 to build that documentation, which really is very, it's pretty gross, but I think the lawyers were trying to recoup all their research costs up front. In essence, essentially the only thing that's needed is the custodian trust. We offer a custodian trust, for example, for $750. There's other players offering them for $3,000, for like $600-700. I know St George even gives theirs away. But again, give it away, just be careful. There's some obviously concerns with that one. But I think that's the major one that you need to do. You need to make sure your deed is upgraded to allow borrowing. So it means if your deed's been upgraded since 2007, you're okay. If it's before that, you upgrade that. Cost of that is probably, again, I can just go buy what our business does, but it's $400 to do a deed upgrade. So you're up around about the $1150 mark. If you're borrowing from a NAB's CBA or something else like that, they'll do all the borrowing documentation for you. So there's no cost on that one. So that's really, in essence, your costs. On top of that is if you're doing a self-financing borrowing, and I've done one recently where a member of the fund had $1 million. They couldn't put the money into the fund per se because they'd already gone up to their non-concessional contribution caps. So what they did is they went out to the marketplace, or they effectively lent the money to the self-managed. The self-managed super fund then went and bought a whole list of shares, which then they put a custodian, but then we needed to put a borrowing agreement or a loan agreement between the member and the trustee of the fund, and that probably costs around about $500. So the costs aren't huge. The end benefits are it's a matter of accumulating wealth in this very tax advantage vehicle for a long term. And as I said, with the self-financing, this is a way of a person going and acquiring shares fairly cheaply and making sure he gets a long-term gain in the super fund's name, not necessarily in his name.
Thanks for your time today, Grant.
My pleasure. Love to talk about SMSF borrowing.